Well, good day everyone. Chris Weston here, Head of Research at Pepperstone. And today we want to focus on what's happening in the precious metals markets because we've obviously seen a really strong move up in gold prices. I think gold's up now in US dollar terms, up 16% from last year's lows in August. We've seen a huge move up in palladium, up some 77-78% since mid last year, and silver prices have had a strong move as well. And we've seen a lot of client interest, not just to speculate on gold in US dollar terms, but also in euro terms and also Australian dollar terms, which have had a really strong move as well. And I think when we're looking at gold, the first thing we want to do is understand, is gold and silver and palladium having a strong move up in all currency terms, which it has been, and it's been a reflection that gold has effectively been used as a currency in its own right, and where we've seen a lack of appeal around any kind of G10 currency, whether we're looking at US dollars, euros, Australian dollars, NOK, Swedish krona. Yeah, none of them really have any kind of strong appeal at the moment. And I think gold and silver have worked as alternative currencies and this best house in a bad neighbourhood in that situation. But I think as well, we've seen a lot of people looking to speculate on price moves as well. And the idea that perhaps we've had a strong run, we've seen a bit of flow recently on the short side and people looking for a down move. But overall, the longer term situation is that people are very much in agreement that price of gold goes up to test that sort of 1390, 1370 kind of area, the supply zone, and perhaps even higher longer term, given what we've been seeing. But also I think it's very much a reflection of people looking to use gold in a broader portfolio. They've got their equities, they've got some fixed income, but they've also got gold very much in there as a sort of hedge against kind of this economic fragility we've been seeing. Now I think if you have a look at the bond market as a guide here, the fact that we've got, bond yield curves in the US testing multi-year lows again. In Germany, we've got the difference between 2 and 10-year bunds sitting around 66 basis points, not far off multi-year lows. Here in Australia, the difference between 2s and 10s Aussie government bonds sits around 34 basis points. Yeah, there has been a rampant flattening of the curve again, and the idea that the longer-term inflation expectations continue to fall, and the idea that global growth is very much in a situation. If you have a look in the US, we do know that we see a situation where the Fed tends to be on a pausing cycle. It then subsequently goes into a cutting cycle ahead of a recession, and that same dynamic is being portrayed in the US rates market as we speak. If you have a look at what's priced in for this year in the euro dollar futures, we've got about 2 basis points of hike, so there's an extended pause there. But if you go into rates pricing for 2020, we've got 17 basis points of cuts which are being priced into. So this model that we see where the Fed will go on an extended pause, and then after that situation they will always cut rates into a US recession, is something that will keep gold bulls fairly happy. If you see a situation in the global bond market where the level of outstanding debt with a negative yield effectively means if that government was to go to market and look to raise money through the bond market, you as an investor would be paying them the right to borrow your money, which is obviously a completely crazy situation. But why would you buy a bond with a negative yield? Well, you'd obviously expect price to continue going up and yields to go down, and you could buy it with a negative yield and obviously look to offload that at some stage with a lower negative yield, or a bigger negative yield, should we say. And that ballooning pool of negative yielding debt that we've got out in the market sits just over $9 trillion, which is the highest level since December 2017. And there has been a strong correlation between gold and this rising pool of negative yielding debt that's been going forward. Now, this idea that equity markets continues to push higher, I think, is a reflection that we've got fairly low inflation expectations. Real bond yields continue to move lower, which is great for the future, or the appeal of the future cash flows of these businesses. But I think as well, what we've been seeing is this huge turnaround from global central banks. The PBOC have started turning on the liquidity taps again quite aggressively. The Fed have done a 180 on their balance sheet, and also in terms of rates. The ECB are talking about new cheap liquidity to European banks. And the RBA as well, have mentioned what's going on with the downside in that situation. So we've got a much more supportive central bank situation, which is supporting equity markets. But if you look at the bond market, they're not buying it at all at the moment. And gold has been a really good hedge against this economic fragility we've been seeing there. Whether we see a recession, certainly the rates market is telling us that's still a very likely situation. So our view is very much that gold will continue to go up. It will find buyers on any kind of pullbacks on this overbought situation. But gold, in my opinion, is is in a perfect storm. You've got the fact that it's working as an alternative currency, and there's not really much appeal for G10 currencies, so gold looks good in that situation, but it's also a really good hedge as part of a broad portfolio against economic fragility we've been seeing there. And so therefore we would be looking to buy the dips in gold prices going forward, with the idea that potentially this goes much higher from here.